Welcome to this explainer. Today, we're putting NXP Semiconductors on the scale. We're going to look at this really fascinating tension between a fundamentally stellar company, one with an incredible long-term trajectory, and the reality of its current stock price. It's the classic dilemma. What happens when a business executes flawlessly, but the secret is completely out and already priced in? How do we evaluate an opportunity when the broader market is already hyper-aware of the upside?
To figure that out, here is our roadmap for today. We'll kick things off with the NXP transformation, dive into why it might be priced for perfection, look at the long-term upside, ground ourselves in the cyclical reality, and finally, wrap up with Wall Street's verdict. Let's get right into it.
Section 1. The NXP transformation. So historically, NXP created massive shareholder value by pivoting away from just churning out generic consumer chips. Instead, they got smart. They built really deep exposure across highly specialized, broad-based end markets. We're talking automotive systems, the industrial IoT, mobile devices, and communications infrastructure. And hey, that strategy is paying massive dividends right now, literally driving their Q1 2026 revenue growth up 12% year over year.
This perfectly illustrates the genius of their strategy. Think about it. Modern cars are basically just giant computers on wheels, and factories are getting more connected by the day. NXP isn't just crossing their fingers and hoping the world buys more cars. No, they are deliberately targeting devices where the actual semiconductor content per unit is exploding. So even if global car sales completely plateau, NXP's growth is secured because the amount of their silicon packed into every single machine is going way up.
Section 2. Priced for perfection.
Hovering right around $293 to $294 a share, NXP is trading practically at its recent high range. Now, this is absolutely crucial to grasp. We are no longer looking at a deep, cyclical bargain here. The market is fully awake. It's actively giving the company complete credit for a massive recovery across all those sectors we just talked about. If you look at the historical charts for semiconductor stocks, you'll see investors make this mistake time and time again, paying top dollar when the cycle looks, well, absolutely perfect.
So, the million-dollar question is this. Is all the good news already baked into that price? See, when a stock is priced for absolute perfection, your margin of safety basically vanishes into thin air. If future estimates slip even a tiny bit, you're looking at a sharp correction, and that can happen without any actual underlying flaw in the business itself.
Because of this dynamic, we really have to separate the two. NXP, the company, fundamentally rock solid. It's got deep industry moats and massive structural importance. But NXP, the stock, that comes with intense valuation and cyclical risks. At these lofty levels, the stock demands near-flawless execution from management just to match those sky-high market expectations.
Section 3. The long-term upside. Let's talk cash flow, because NXP isn't just out there blindly chasing revenue growth. They are an incredibly profitable machine. In Q1 2026 alone, they raked in a staggering $714 million in free cash flow. That is over 22% of their total revenue. It's not just a flashy number. That kind of cash gives management immense, real-world flexibility for reinvestments, strategic capital allocation, and, of course, aggressive stock buybacks. The real engine here is the automotive sector and the rise of software-defined vehicles. These aren't just cars anymore. They are rolling digital platforms that demand insane computing power, radar, and constant connectivity. And because integrating these highly complex, secure systems takes literally years, the design win cycles are incredibly long. Basically, once an automaker locks in NXP chips for a new platform, that revenue stream is super sticky and secured for years to come.
And then there's AI. But here's the kicker. Rather than chasing that super crowded data center hype train, NXP absolutely dominates edge AI. They're putting artificial intelligence directly into the embedded systems of cars, factories, and sensors. It's a perfect fit for their existing strengths. Like we said earlier, even if global auto sales stay flat for a decade, NXP's revenue keeps climbing simply because each individual vehicle is going to require exponentially more of their advanced edge AI chips.
Section 4. The cyclical reality.
Now, let's talk about the silent killer in this industry: inventory digestion. Historically, semiconductor earnings look their absolute best right at the very peak of the cycle. Customers get spooked by potential shortages, they overorder, inventories bloat up, and then suddenly, boom, they slam on the brakes. Distributors start normalizing their stock levels. When that happens, NXP's revenue growth can really disappoint, even if everyday consumers are still out there buying cars and gadgets at a totally normal, stable rate.
So this is the core conflict right here, a real tug-of-war. On one side, you have these massive structural tailwinds pulling them forward,
like edge AI, software-defined vehicles, and industrial automation. But on the other side, they are constantly battling immediate, short-term cyclical realities, sudden inventory digestion, fluctuating auto production, and shifting timelines for EV adoption.
We also can't ignore the intense margin risks. In the semiconductor world, margins are notoriously sensitive. Just a slight shift in the product mix, a return to normalized pricing, or a factory not running at full capacity can severely squeeze profitability. Throw in some fierce competition from other massive analog and MCU suppliers, forcing them to ramp up R&D spending, well, let's just say even tiny hiccups in gross margins can drastically hammer their earnings per share.
Section 5. Wall Street's Verdict.
Looking at the consensus right now, sentiment is overwhelmingly bullish. You've got 7 strong buys and 18 buys. Wall Street clearly views NXP as a tremendous compounder, totally banking on their highly attractive long-term exposure to the auto and industrial spaces, not to mention that massive free cash flow engine we talked about.
But hold on a second, let's not ignore the skeptics. Those 6 hold ratings are actually incredibly telling. They aren't saying NXP is a bad business at all. Rather, they're laying out a very specific story of caution. They're pointing out the reality that at these elevated valuation levels, hovering right near recent highs, the stock simply has virtually zero room for disappointment. If industrial demand goes soft or automakers unexpectedly pull back, the margin of safety for anyone buying in today is razor thin.
Which leads us to the ultimate question. NXP has successfully transformed its entire business model for the modern era, and there is no doubt it's a high-quality company. But as the cyclical gears of the market inevitably keep turning, can they actually execute flawlessly enough to justify paying top dollar today? Knowing the difference between a truly great company and a perfectly priced stock is the real test for investors. Thanks for joining me for this explainer. Keep questioning